Good morning, everybody. This is intimidating. I wasn't going to do a podium until I saw the other presenters and changed my mind very quickly, so bear with me here. I'm excited to be here. We have been involved with Verivest as a partner with the gold level membership with them for the last couple of years, and it's just been really valuable. We've been able to send a lot of our current clients to Verivest to look at other opportunities that maybe we couldn't offer. We've gained a lot of clients through the Verivest portal, so we see huge value in that and are excited to be here, so thanks for having us. A little bit about myself. So I had to go back the timeline because I feel like I just got in this industry not long ago, but it's actually been almost 18 years, so that's pretty interesting. I got into private lending in 2005. I actually had stayed home with our kids, had seen my parents invest in real estate and saw the opportunity that it actually provided them to create some wealth for themselves and for our family, but had a friend that was in private money and knew nothing about it, and he said, "Come work for me." And I said, "I don't even know what you do." So fell into private lending and actually started at the ground level as a loan originator, quickly moved into escrowing notes. We did a lot of private lending back in that time on raw land and actually subprime owner-occupied properties. And then quickly moved into a capital raising position and a fund management position and got my securities license. So stuck with that company till about 2008 when everything imploded. And then actually stayed on for several years to clean up the disaster, learned a lot, got a lot of bumps and bruises, but landed at Secured Investment Corp back in 2011. So I wasn't sure I was going back into it. Anybody that went through that market knows that there were a lot of challenges and wasn't sure that that was my path, but actually got drawn back into it. So was happy to land at Secured Investment Corp. At that time, we were a big private lender, so we lent money to real estate investors that were mainly fixing and flipping. So we created short-term loans for them to provide them purchase money and then also rehab funds. And we would basically pair them with lenders, which I believe a couple of the people that already spoke talked a little bit about that model. It's very clunky. Borrowers get a little itchy when their loan's been approved, and now I'm trying to partner them with an investor that's using an IRA, and it just takes a lot of time. So we quickly decided that we were going to open up our first fund. And that was pretty exciting for us because we did have a lot of clients that liked to fund one-off notes, but we also had a lot of clients that wanted something a little bit more passive. You know, they didn't want to take on some of the headaches that can come along with funding one-off deals, and so the funds were a nice option to actually be able to offer everybody. And so we opened our first fund. It was a 5-year fund, and so we wound that down starting in 2014, and we opened up what we call Secured Investment High Yield Fund 2. So I've got a lot of experience in managing investor relations, managing the fund. I'm a real estate investor myself. My husband and I have tried our hand at fixing and flipping. It's not quite as glamorous as Chip and Joanna, just so that everybody knows. We made it through. We didn't get divorced, but we flipped a few houses, and now we hold quite a few rentals in our portfolio. So just a little bit about myself. A little bit about Secured Investment Corp. So we are, like I said, a private lender. I think the other interesting thing to mention about our company is we actually are in the education space in addition to private lending. So we actually educate individuals on how to be active real estate investors. And so we will teach them strategies like fix and flip, buy and hold. We educate a lot of them how to be brokers. And we do this so that this feeds our funds in addition to educating people and creating more sophisticated, educated real estate investors. So we've been around quite a long time in the education space, really active in the private lending space for the last 15 years. And our team has over 25 years of combined experience in private lending, in real estate investing, and then also in managing assets. We work with a lot of clients, high net worth, that are looking for sometimes cash flow. A lot of times they're also looking for growth. We deal with a lot of clients that use what they would consider self-directed IRAs, 401ks, and things of that nature. We do a lot of business with Quest, so it was really nice to see that they're here. And so, you know, our funds are a way that people can either create that passive real estate income for themselves or also growth. So, just to touch on this, and you guys are very sophisticated, so a lot of you understand these things, but I always think it's important for some of the new people that are here to understand why passive investing is a good option. This is an opportunity. It opens the doors for you guys to invest in various types of assets and not have to be so hands-on with it. It is secured, so the real estate assets that we invest in are secured under the fund's name. The fund owns these pieces of real estate, and we'll talk a little bit more here coming up about how we diversify our funds. It allows you guys to have diversification, and I talk to a lot of clients, and just as a side note, we sell notes also still. But a lot of these clients come to me and they'll say, hey, I've got $100,000. I'm looking to invest it, I don't want to take on headaches. The funds are a nice way to diversify because you could take that $100,000 invested in the fund and be diversified over hundreds of assets in comparison to just buying a one-off note. Now, if it is your appetite to potentially take that property back, then the notes might be a better option. And then it's very hands-off. Our clients really enjoy our funds because they're not having to go out and deal with tenants and toilets. They're not having to find the deals. They're not having to try to lend their own money and do a due diligence process on it. They really appreciate the fact that it's hands-off and they can enjoy their lives with their families. So a little bit about our team. I'd love to take all the credit for the success of our funds, but we have a pretty large team. So we're located in a town called Coeur d'Alene, Idaho. Anybody familiar with Coeur d'Alene? Yeah. We tell people it's terrible. We tell people there's lots of bears, there's lots of bugs, because there's lots of people moving there. But we have about 100 employees at our corporate office in downtown Coeur d'Alene. And I think this is one of the things that I'm most proud of about our organization is we have a very large team behind us that makes the wheels turn and create profit for our fund members and our funds. So we have an acquisition team. Our fund is diversified. So we do lend out of our fund. I'll go a little bit more into that. And then we also buy real estate assets in our local market. So we have an acquisition team. This is a team of people that actually sit on the phones. They call out-of-town homeowners. They are meeting with people in our local market. They're finding properties through distressed landlords. We actually go to the foreclosure auction on a regular basis, almost every Friday. And they actually find the real estate assets that our funds purchase and write the offers up. And then as a fund management team, we decide if we want to move forward with actually acquiring the property. And there are 3 key people that manage our fund. Myself, and then our CFO and our CEO are the 3 fund managers. So we make decisions on whether we're going to buy these pieces of property or if we're going to pass on it and move on to the next opportunity. Again, I mentioned education, so we have a big education component to our company. And the reason that we do that is twofold. One, we have a passion for educating people on how to be really successful real estate investors. But we also do that because it actually feeds our funds more qualified borrowers. We get active brokers that are sending us deals for our origination side of our funds model. We have an origination team, so we have loan processors, loan officers, we have an underwriting team, we have legal counsel on staff that goes over all those deals. We also have a servicing team, so we service about 500 notes right now, so these are the notes that we run through our fund. We have a team of 10 people in our servicing department that actually will make sure that our borrowers are making payments. They are making sure that our borrowers are getting their rehab done, so we actually have a draw processing component to that division of our company. And then we actually do have foreclosure management in addition to just your standard servicing options. We are also a licensed and bonded construction company. So these assets that we're buying that we're going to actually go in and do some rehabilitation on the property to and do a value add, we will actually send our contracting crew in there to actually rehab the properties. And then last but not least, we actually have a property management company too. So some of these properties, especially now that the market is starting to shift, fix and flip has been very profitable in the past for our funds, but we're also able to pivot and we're seeing a lot of opportunity with owning rentals and actually cash flowing them. So we now have a property management company that can actually manage those assets. So let's talk a little bit about how we diversify our fund. And a lot of people get up here and talk about ours is an equity fund, ours is a debt fund. Ours is actually a blended fund. And so what we do is we actually take 25% of the fund balance and we actually deploy that capital through assets in our local market. So that's going to be in Spokane, Washington, and specifically in Coeur d'Alene, Idaho. Like I said, in the past, we've bought a lot of those assets to actually fix and flip for a quick turn and profit. But as we are starting to see the market shift, we are not seeing values decrease, but we're actually seeing days on the market increase. And so we've actually started pivoting our strategy. We're starting to rent a lot of those properties. We've actually sold some on contracts. So we're always looking as a team, as far as the asset goes, what is going to be the most profitable for the fund. And so 25% again of our fund balance is actually deployed through those types of properties. And we specifically focus on single family 1 to 4 units. So that is our space as the residential real estate market space, and specifically the affordable housing market space. So one of our key indicators for us, whether we're gonna do a deal or not, or whether we're gonna lend on it, is we wanna stay under the FHA cap. We believe there's more opportunity for our borrowers to be successful, to get out of the deals and pay us off quickly when they're under that FHA cap. In the event that the plan doesn't go as planned, they could potentially rent it, things of that nature. So we do, again, stay in single family up to 4 units. And then the other 75% of our fund balance is lent out through first lien position notes. So again, these are the notes that we originate. These are the loans that we provide real estate investors funding for when they are either purchasing or refinancing an investment property. And these loans are all first lien position notes, secured again by the residential properties, and they all have to be non-owner occupied. So we're not gonna lend to anybody that's buying a house for their kid to live in or for them to live in. These are short-term loans, so 12 months in nature, okay? So one of the things that we're realizing as a team that you have to pivot, right? Just because maybe the fix and flip strategy was very profitable for the fund in the past, we are always looking forward to market changes, and we're noticing, obviously, as you guys know, interest rates are increasing, property sales are starting to cool off, and we are seeing that not only in our market, but also for our borrowers. So one of the things we're really focusing on this year is the rental market space. We are seeing that Goldman Sachs projects further declines next year in property sales, at least another 8%, existing home sales another 14%, and the housing GDP another 9.2% drop. There are a lot of interested buyers that probably would have purchased homes a year ago that are sitting on the sidelines now and are starting to rent. We are seeing the rental rates in our particular market increase greatly. So again, we're gonna look at what's most profitable and what our best return on investment is for the fund. So this year for our focus for 2023 coming up, we're gonna continue to originate. One of the things I have to say about our fund is we have multiple streams of income coming into our fund, and what I mean by that is we have interest payments coming in from our notes, we have origination points coming in, and then on the property side of things, we have the profits from the property sales, and then also the rental cash flow. And we like that because for us, our target rate of return is 10%. We have an annualized 10.4% for the lifetime of the fund that is actually paid out. And I do think that that bodes to the fact that we've been able to adjust. We are very in tune with our origination team. We know exactly what their pipeline is. If they're having a slow month, we can ramp up property sales and vice versa. So we're gonna continue to originate. We're gonna continue to do construction on some of the properties that we can add value to and sell. That will not stop, and we will continue to do that. We are gonna begin to start to rent for cash flow. And like I said, that's something we added Q2 of this year. We were starting to see this start to happen. Properties were not selling as quickly as we thought, and we've been able to successfully rent those. So we will continue to hold assets for cash flow. One of the things that we've also looked at is we get a lot of clients that want 1031 exchange options. and they want turnkeys. So even these properties that we're renting for cash flow will also start to look to sell off to some of these types of clients, because unfortunately our fund does not offer options for a 1031 exchange. And so that is one of the components that we will add to the rentals that we're holding, is we will start to market those as turnkey. We've actually sold quite a few already. And what that does for the fund is, we can recoup our capital and we can actually go and buy and originate more. And then we're going to focus on property management. I will tell you, one of the things that we've really struggled with as a fund management team is really third-party resources, property management, loan servicing. And so we have decided as a company that we had invested in the software systems and the people to actually bring those types of services in-house. So we're building out our property management company, and actually we, up until last week, we're just managing our own portfolio. Now it is actually open to other individuals to bring in rental properties. So we believe too that that will actually provide a better service for these turnkeys that we're gonna sell also in addition to that. So, and Matt mentioned this. I love that he mentioned understand from an operator what your reporting looks like. I get so many clients that call me and say I invested in a fund and they don't give me any reporting, and I'll ask them, well, did you ask them how often they report and how that would be delivered to you? Well, no, I didn't ask that. I like to be really clear about that. We report on a quarterly basis. Our reports and our earnings go out on the 15th of the month ending the quarter every quarter. And we're pretty proud of that. It's interesting to me that there are a lot of operators out there that don't do that. It's not a small task. We have a massive accounting team that is behind us that puts the numbers together, and a marketing team that actually puts the physical reports together. But again, we're very transparent. You're going to see all the activity for the fund. And within that report, you're actually going to see our track record from the time of inception. And we've brought several of those reports with us at our booth, so make sure you guys stop by if you want to take a look at that. This is just a quick page from that actual fund report. So we do keep a track record in there so that everybody can see exactly what we've paid out from the time that we opened the fund. You're going to see how many notes that we've originated. You're going to see how many properties we've bought and sold. And then there's a lot of other information within that report that is very specific to the quarter, to include a profit and loss page. So our fund, which we call Secured Investment High Yield Fund 2, has a minimum investment of $50,000. It does have a tie-up period of 12 months, so it's a little bit shorter tie-up period than most. Quarterly earnings, they can actually be paid out or they can be reinvested. For those folks that have self-directed IRA accounts, this is pretty powerful. As you guys know, when these dollars go back and forth to your custodians, that's, can get costly. And then sometimes you have small dollars there that you can't redeploy. You can actually choose to reinvest your earnings. But it's really up to you. You can set the accounts up however you want, and you can also change it down the road. I've had a lot of clients that say, hey, I don't really need the cash flow. I'm selling my business in 2 years. That's probably going to change. You could always set it up in growth, what we would consider growth mode, and then you can set it up to actually pay your earnings out down the road. And this is a mistake. Historical average annual return is 9.7. That's what we paid out last quarter. Our annual lifetime yield is 10.4%, and you guys will see that in the fund report if you grab one of those. Again, our asset allocation is 25% in real estate acquisitions, so single family up to 4 units, and then 75% is lent out in the first lien position mortgage notes. All right, so we would love to talk with you guys more if this is something that you're interested in. Where I think our fund fits perfectly in people's portfolios if you're looking for cash flow and you don't have some residential real estate assets in there. Our fund is a very quick cash flowing fund. Our intention is to fund these first lien position notes, sell them off, recoup the capital for the fund, and turn the fund over as many times as we can. And then also with the real estate assets, it is a short-term play on that. I appreciate everybody's time. I'm thankful to be here. I see some familiar faces that I've only talked to on the phone and through email, so it was exciting to actually meet them in person. And stop by our booth if you'd like more information.